right, everybody. Good morning. Welcome to Wednesday's Open Forum. I'm your host, Ryan Langley. And today we have a very special guest from Waterstone Mortgage. He's going to give us an update on what's going on in the mortgage world, rates, and all the exciting things going on. Mr. Tom Weinard with Waterstone Mortgage. Tom, welcome. You're on mute.
Thank you, Ryan. Good to hear from you. Good to see you. You're looking sharp as always. What you want to know?
Tell us what's going on out there in the mortgage world.
Who's
what rates are
fun selling real estate these days, huh? I hope everybody is. And all kidding aside, I'm happy to be here to talk to you guys. Two things I want to talk about today. One is our current rate environment and what's expected for the future. And how you guys can stand out with listings and flexible options for your buyers. And I'm going to compare two different programs that can be beneficial whether you're on the listing side or the buyer side. So who knows what the average interest rate is today? I like to ask you guys questions, so feel free to please jump in, type something in there, shout out. You know, what do you think the average interest rate on a 30-year fixed rate loan is today?
We got a 5.25 offer.
Okay.
5.5.
Half.
Okay, I'll let you read it.
Yeah, thanks. I can read good. So it's really easy to Google search current mortgage interest rates, and the interest rate is determined by about 19 factors, with the most important being credit score and loan to value. So how much money are they putting down and what's your credit score? I just looked at the chart for a 30-year fixed. With a high credit score, it's 5.9. And with a low credit score, it's up to 7. So that's the range we're dealing with. Frankly, most of my clients are in the mid to high 5s. A couple are in the low 6s. There are ways to get that lower, but you have to be creative. Who knows what interest rates were in the 1980s? I remember? It's a whole lot higher than that. Okay, yeah, 13 would have been low, Samuel. It was up to 18%. Hashi hit it. That was about the high point, 18, 19%. My first house, my wife and I built in 1992, and our interest rate was 9.25% on our loan. Now, it didn't cost me $300,000 for that house. It cost me a whole lot less in 1992. But the point is, if I were telling clients today that their interest rate was almost double what I'm quoting them, most of them couldn't afford to buy what they want to buy. So historically, we are actually in a really good spot for interest rates. And in terms of financial security and a healthy economy, being in the 5s and up to 6 is actually a good thing. I know it's not what we're used to over the last few years, but how many people who thinks we're going to get back to 3 and 4% rates sometime in the next 3 to 4 years? Okay, anybody? Well, that's the prediction. Okay, right now the expectation is that rates will continue to climb slowly, and at some point in the next 2 to 4 years they should start to come back down. The other thing that's really easy to Google search is mortgage history, mortgage interest rate history. You can look at a 10-year period, a 20-year period, a 30-year period. And while we had all those high numbers in the 80s and then in the 90s, once we got down to this 5 and 6, in the early 2000s, when I started in the mortgage business, we were in the 3s and 4s. After the crash, we were in the 6s and 7s. 2-3 years ago, we were in the 3s and 4s. And today, we're in the 5s and 6s. So what do you think is going to happen 2 to 4 years from now? We're going to be back down in the 3s and 4s, most likely. Now, that may not happen. I can't guarantee that. But if we just look at history, and that tells us that there's a very good chance that rates are going to drop. Okay. They may not get back to where we can find, do 2.5% on 15-year fixed mortgages, but we might get pretty close. So the key today in talking to buyers is it's okay to buy a house today at this rate and not be happy about it, number one. But you also have to realize that most people stay in their first house 3 to 5 years. So a lot of those people are going to be selling that house and buying another one at a lower interest rate, or they're going to decide to stay in that house for 10 more years till their kid gets out of high school, and they're going to refinance into a lower rate. It's just the way the cycle works. So that is the expectation from the people that I listen to and the things that I subscribe to kind of give me an outlook on what's happening with the rates. Okay. Any questions or comments on where we are with rates? You let them unmute themselves, Ryan, or do you make them be real quiet?
They can unmute themselves, Tom. They're choosing not to.
I know. Yes, it's always fun when I ask questions, and I always ask people, raise your hand if this, and nobody raised their hand, and I ask, who's not going to raise their hand no matter what I ask? There's always somebody.
They're very shy at the beginning, and then at the end, when I'm hungry at lunchtime, they won't stop talking.
All right. So, what are the options that you have that you can stand out? Okay, what's going on with the market, real estate market? Are we shifting to a buyer's market? Is anybody seeing that trend? Are we starting to see more offers getting accepted with contingencies to sell homes? I walked around the office yesterday afternoon to prepare for this and talked to a handful of loan officers. Every single one of them said they've had 2 or 3 contracts in the last week come in with contingencies on the sale of their current home. And in some cases, they weren't even listed. So we all are seeing, and I believe that the future is we are shifting back to a buyer's market. We are going to see pricing compress a little bit. So we're not going to see these 30, 40 grand over asking price anymore. We're going to have more buyers asking for seller concessions. We're going to have more buyers offering below asking price. I know you guys always have sellers that listen to you and list their house at the price you tell them to, right? We know that's not true, but we're getting back to that. That all the signs that we're seeing and all the projections I'm seeing are pointing to that happening. So what does that mean for you, and what can we do to kind of stand out? Let's talk about it from the listing side first. So I want to give you a comparison, and you don't have to, you can write some of these numbers down if you want. I'll keep it as simple as I possibly can. But let me get to the right thing here. Okay, so we're going to take a $500,000 purchase price and a 5% down payment from the buyer. Okay. And we're going to compare a buyer offering $480,000, so $20,000 below asking price on that house, and what that does to the amount of money, the proceeds that the seller gets, and frankly, how it affects you as well. If you reduce that price by $20,000, you reduce the profit or proceeds to the seller by $20,000, right? That's a significant amount of money. But if you look at doing some creative financing things, and the program I'm going to talk to you about is been around for a while. It's called a 2-1 buy down. Anybody heard of a 2-1 buy down or remember that from 2008 to 2010 after the crash? We were doing quite a few of these because of where rates were going and all of that. So I'll explain how that works and how that can benefit you if you have a listing where you're getting offers coming in below that asking price. The way a 2-1 buy down works is it is a seller or lender funded concession or buy down for the buyer. The buyer cannot pay for that. So in this same comparison, I'm going to take that $500,000 sale price and I'm going to still have that buyer make a full price offer, but ask for $10,000 in concessions. Okay. So now your seller is only losing $10,000, not $20,000. What else does that affect from your perspective? You guys, how do you guys get paid?
Commission.
Selling houses, right? So 480 versus 500, that's a change in your commission, right? So if we can keep the sales price where it is and benefit seller and buyer, That's a win for both sides. All of us win. So the way it works is we take that $10,000 and it buys down the interest rate for the first 2 years for the consumer. So if we take that 5.875 interest rate that we're using as an average today, a loan amount of $475, and we look at the monthly mortgage payment, it's $2,800. Okay, so that's a number you can write down. Okay, $2,800. That would be the payment if they just flat out bought the house, did a 30-year fixed at 5.875. Okay, the way the buy down works, it's a temporary buy down, and in the first year, the reason it's called a 2-1 is in the first year the interest rate is 2% lower. So it's a 3.875 interest rate in year one. So for 12 months, that buyer is not paying $2,800, they're paying $2,200. A little over that, it's a little short of a $600 a month savings. That's $600 over the next year per month, or $7,000 roughly, that buyer is saving by doing this program. In the second year, it's 1% lower, so it goes from 3.875 to 4.875. That payment is $2,500 a month, so still $300 a month less. That's another $3,600 that buyer will save, okay, over that year. Then in year three, it hits that 5.875, okay? What concerns do you think most people would have when they hear about something that has a temporary interest rate? Somebody give me an answer on what you think a concern would be.
That it's going to increase over time, like a adjusted rate.
Right. Great point, Tammy. So that's exactly right. So while over the last few months, I have actually been locking a few clients on 5- and 7-year ARMs because they were priced a 0.5 point to 0.75 point lower than a 30-year fixed. And that consumer understood that that rate would be fixed for 5 to 7 years, which is a pretty long time. And that they felt confident they would have the opportunity to refinance that property if they didn't sell it before that rate went up. The last time we did ARM loans, I did a bunch of them in the early 2000s. My clients were all calling me at 4 years and 6 years going, what do I do? My rate's going to change next year. And I look at the current rate and go, well, first of all, say thanks, Tom, because your rate's going to go down, right? It doesn't always have to go up. It can go down. So if you do a 5-year ARM today, that rate could be lower 5 years from now, because if the projection of 2 to 4 years of starting to see a rate reduction happens, they may not have to do anything. Their rate might just go down automatically. But Tammy makes a good point, and the security of this 2-1 buy down is it does not, that 5.875 is it. That is the fixed rate. Again, it's a temporary buy down for 2 years, but that 5.875 is fixed. There's also nothing stopping that client from refinancing that to a 3 or 4% rate 3 to 4 or 5 years from now, whenever rates get there. Okay.
Are you qualifying them on the 5.875
yes,
initially?
They have to qualify at the high rate. Yeah. Mm-hmm. Just like a shorter term ARM, like a 3 or 5 year ARM, we typically have to qualify them at a higher number. Yes, good question. Any other questions on that product?
What's the credit score?
Oh, sorry.
Actually, I believe it's 680 is the, no, that's a different product. It's about 680, I think. Actually, it's yes. Okay, yeah. So it's a great program. Now, how can that help you with a listing, right? Well, you can advertise it. I think I've sent you guys, or sent through Ryan, copies of listing flyers that we can do. We can do co-branded listing flyers that you can put in your open houses, which you're probably going to be doing more open houses coming up in the future. It's a leave behind that a buyer, potential buyer, can pick up and walk out of there with your info, my info, and 2 to 3 rate and payment options. We show them, if you do a traditional 30-year fixed, here's your payment. If you do 7-year ARM, here's your payment. We'll compare 5% down, 20% down. And we can throw this 2-1 buy down in there and advertise a lower rate, you know, with the caveat that it's going to be higher. But I think most of the time as a listing agent, you're going to want your seller to accept a full price offer with a $10,000 concession compared to a $20,000 price reduction. Even if it's not a $20,000 price reduction, even if they want to buy $10,000 less. For the consumer, the buyer, if the seller is going to walk away with the same amount of money, but the buyer is going to benefit by getting that $10,000 concessions, which they can use to do this program or simply reduce their out-of-pocket expense, then it's a pretty good win for everybody. Question on the 2-1 buy down. No, it is only for primary residence purchases. No second home or investment property.
Tom, is this product capped at the 575 or 5875?
It's whatever the interest rate is that consumer qualifies for.
Okay.
So it could be 6.25, it could be 6.5, depending on where their credit score is, and then that buy down would fall in line. So let's say they don't have a great credit score, they're at the low end of the tier, the rate's 6.5. So first year it's going to be 4.5, second year it's going to be 5.5. It's always 2 points down and then 1 point down.
Okay, so that's a great program, having lived through the 15 to 19% swings.
Yes, sir.
But the traditional interest rate over what Case-Shiller's last 100 years is somewhere between 5 and 7%.
Yep.
So are you expecting the Fed to ever get us back down to the almost zero platform without a huge recession? Or is it 5 to 7 pretty much what the market should expect?
You said the R word, George. Yeah, we're probably headed towards a recession. Most people need to realize that that's happening. If they can't get inflation under control, which it's insane how high it is. It's over 8-9% right now, and historically it's 1 or 2%. I mean, it's just crazy. So, but here's the thing: the Fed and their interest rates have a relationship that a lot of people don't understand. And one thing I think happened, and one good result from the crash of 2006 and 7, was that the Fed learned how to manage this so that we don't have that happen again. Every now and then I'll hear somebody with gloom and doom that we're facing another bubble. It's going to crash again. My house is going to drop $40,000 in value. I don't listen to too many people that believe that's going to happen. Again, will it start to flatten out? Yeah, it's already doing that. And will we go back to 2 or 3% value growth instead of 10 or 12%? Yes, that's what's most likely to happen. But the Fed, when they the Fed raised the rate a few weeks ago, right? Do you guys know that mortgage interest rates actually went down for a few days after that? Those Fed changes are built into the rate environment. There are all kinds of outside factors that affect interest rates, but the interest rate does not change until mortgage-backed securities are bought or sold. Okay, so if people are buying mortgage bonds, that's a good thing because rates are going to get better. But when they're selling them and they're putting their money in the stock market, because we have a robust economy and a stock market will bring you a higher rate of return than a safe 30-year mortgage bond, that's when we see rates start to change for the negative. Okay, so when the Fed makes those changes, it doesn't mean, oh my God, the Fed raised the rate 0.5 point, interest rates jump from 6.5 to 7. That doesn't happen. Interest rates are not affected by that decision. That rate affects your equity lines, and it affects the money that banks loan to each other.
But, and we didn't get into a policy decision here or discussion, but the Fed has been buying mortgage-backed securities and they're starting to dump those back into the pool.
Yeah.
So that's going to raise rates. So I guess my point being is that interest rates are probably year over year up at 150 to 200 points.
Oh, I mean, I was still locking people in the high 3s 6 or 8 months ago. I mean,
yeah,
it's been that drastic, towards the end of last year and the very beginning of this year, we saw just a huge spike in the first couple months of this year that got us to this 5-6% environment. But I think the projections that we're seeing of possibly rising, maybe we're going to start hitting that 7 I just, no one, I don't really see it going higher than that, but I think we're going to stay here for a while. I think we're going to stay in these fives, these sixes. And then, I certainly hope and believe that we will start to see that come back down again. There are, of course, all the other factors that are going to affect that, but all the projections we're seeing are for a pretty healthy couple of years coming up, as long as we all do the things that we know will work in our industry, which you guys, obviously know how to do, and will be, get your help from Ryan and anybody else you need to. But we like to have as many tools in the arsenal that we can have, and we like to be as flexible as possible. So the 2-1's just a great option. So let me move on to one more product. I've got just a few more minutes before I got to jump on another call. We have a program because Waterstone Mortgage is backed by Waterstone Bank. We are a subsidiary of the bank. We have access to the bank's portfolio products. Those include a lot of ARMs that are priced better than the market today by anywhere from half a point to a point. So if we flip to the buyer side and we try to give the buyer an advantage, I mean, it's an advantage to them to do 2-1, but I think there's a big advantage on the seller side too. But if we look at what we call our Wealth Builder program, the interest rate right now is about a full point below where we are on a 30-year fixed. Okay. It's 4.875 compared to 5.875. Okay. It is a 7-year ARM. So that means it is fixed for 7 years, which again is a pretty long time. A lot of people freak out about ARMs, but a lot of possibility of you getting out of that 7-year ARM and that high rate in the next 7 years. It's a 20-year amortization. Okay. So a 5% down, $500,000 purchase like we compared before is going to give you, it has mortgage insurance. You can do 97% financing, and I believe we go up close to $1 million. You do need a 700 credit score, but the principal and interest is 2,800 and the MI is 300. So we're at that same payment we were on that other option, where just a straight 5.875 30-year fixed. It's only $300 more a month on a payment, which is not insignificant, but at this purchase price, it's also not huge. But here are the big numbers you need to look at. On a 20-year amortization, that's why the payment's higher, because you're paying it off in a shorter period of time. The principal reduction after 36 months is $11,000 more on the Wealth Builder program. So while that consumer can still put the same down payment down, they're gaining 33% more equity in their property. And at the end of that 7 years, if they stay to that full 7 years, it's almost $30,000 more equity that person has in that property. That is a significant number. And it's a great product for our consumers who aren't quite as payment sensitive, but really just hate looking at that high 5% interest rate. And if we can sneak people under 5 in this program, and some of our other ARM programs are there as well, that's a big plus. So again, it's important to be flexible, whether you and I work together, whether you have another lender you work with that may be able to do some of the same things, then that's what you want. You need to have other products. We just added another jumbo product, another jumbo lender that has incredible pricing. It's in the low 5s compared to the high 5s and 6s for loans up to $1.5 million. We have a doctor program. I just closed a loan for a doctor at 6%, 100% financing. It's a great program. Questions? That's about all I got to share today.
Tom, I have a quick question.
Sure.
What are you guys seeing volume-wise as far as number of transactions? You guys staying busy with transactions, like a lot of people doing business?
Yeah, it's been slower, of course. We've all seen a downturn starting about 2 months ago, but we are also now starting to see that uptick. So I think it was just this temporary lull. Personally, I had one of my lowest months this month, but I'm back on track, getting to where I need to be here pretty quickly. So yeah, we're all seeing a turnaround. We're all seeing, again, more flexibility with people getting more offers accepted with concessions instead of, having to do crazy things like no appraisal contingency and huge numbers over asking price.
Tom, you do foreign national loans.
Yes.
Okay. The reason I asked you about that slowing down is I want to commend our group because I've seen the exact opposite, that they have been, I don't know if it's because it's kind of that where it's transitioning from one to the other and it's kind of an even market right now. Buyers are still really, really doing better than historically, not as well as they're not as flexible as they were, to put it nicely, 6 months ago, but they're more flexible than they were 2 years ago.
Absolutely.
And sellers are becoming flexible. So it just seems we had record month in June.
Awesome.
It just seems like we're right at that sweet spot right now where everybody's willing to make a deal, and it kind of everybody feels like they're going to have to give when they go into a deal. Whereas sellers were not, as you know, a year ago, sellers were not friendly, and 5 years ago, buyers were not friendly, and so I think the seesaw is going back toward the buyers, but right now it's kind of in the middle, and it seems like everybody's really willing to make a deal, and we're putting up big numbers transaction wise.
That's awesome.
Yeah, so I want to commend this group. They're doing really well.
Good job, guys. If you need my help with those buyers, let me know.
Perfect.
I'm here for
Tom, I know you got to go. It's 11 o'clock. I appreciate you coming in. Thank you very much for everything. If anybody have questions, Tom, do you mind hitting the chat on your way out with your information?
Yep.
If anybody has a question for Tom while he's typing, let him know.
If I can spell Waterstone, I've only been here 13 years.
Water and stone, you can do it.
I did it. Yay.
All right. Well, thank you, Tom. Have a great day.
You too. See